Okay, hi everyone. Welcome back again to the Quantitative Investing Festival 2021. We are in the sixth sharing session of the festival, and I want to thank everyone once again, not just for being here today, but if you have been with us from the very first session on the 11th of September, thank you for your great support and the team from iFAST Global Markets, as well as our education partners, Allquant. We are truly happy to have been able to share with you so much so far on quant investing and its underlying strategies and principles. Throughout the festival, we have gone through a number of topics, including the basic concepts of what risk is about, how it's to be managed quantitatively. We talked about what quantitative analysis is about, how do we get clarity in our investments. We also talked about how do we use volatility as a distinct asset class. And then just 2 days ago, Ingwan from Allquant shared with us the basic principle of the all-weather strategy. Today, we are going to temporarily place these thoughts and ideas on one side, and we're going to take a valuable look at ourselves as investors. How are we doing as individual investors? Are we well equipped? Are we well trained as individual retail investors to have the right habits so that we can get that consistency in our investing? Are we ready to move towards consistency in our level of profitability over the years? And if we are new to investing, how should we prepare ourselves to go on a journey of wealth accumulation for the next 10, 20, 30, 40 years down the road? Okay. So before I start, for those of you who may not know who I am, I'm Dao Wei from iFAST Global Markets. I'm an investment advisor for clients using the iFAST platform, and I help to manage investment portfolios entrusted to us to be grown over time for the many years ahead. I'm working together currently with our education partner Allquant to run this Quant Investing Festival. And the idea we have is not just to share and educate everyone on quantitative investing, but we also want to come in and really equip people, you guys, with that readiness of the heart and of the mind before we go about that investing. So before I begin, let me just also mention that today's session is also run concurrently for our ongoing CSR project, working together with the Singapore University of Social Sciences. Today's session is one of the sessions for our investment advisory case challenge 2021, where we are sharing with students from SUSS on the different considerations for client advisory and managing an investor's emotions. So I do see a number of familiar student names today. Offhand, maybe just from my big memory, I'm guessing that you guys were also present for our last CSR project on impact investing. So glad to have you here again to come and learn about investing together. And also just many thanks to Mr. Patrick Tan from SUSS as well for helping to make this case competition happen for your students. And without further ado, let's go into the topic for today. So if today, we want to talk about creating consistent profitability, So how do we go about today's topic? When I thought about this, I came up with something that I hope many of us would be able to consider today, And one of the key questions that we can try to ask ourselves first, as a new investor trying to have consistency is this question. Okay, so what is this question about, A first-time investor's common question usually is something along this line. What should I buy? And this is very, very normal. If today you have 10K, 50K, 100K, 500,000 sitting as spare cash in a bank account, and you have never thought about how to do investments at all, you have no background in finance, and you have absolutely no clear idea how to go about investing, but still you want to grow your money, Then this question is probably the burning question on your mind, But at the same time, let me also just ask everyone this question, right? How many of you, right, for those of you who have invested before, right, how many of you at the start, maybe you ask yourself this question more, right? But nowadays, when you think about how you should go about your investments, right, maybe you think that this question, you might not want to ask it so early, right? Maybe you only want to ask this question when you reach near the end of your consideration. Right? Actually, a lot of times, right, we do find ourselves in a situation whereby we start to think, there are so many ways to invest, right? There are so many ways to go about our wealth accumulation. Right? So much so that what we buy, right, is actually now going to be that final outcome. Right? What we want to do is have a lot of considerations first. Right? So what we realize over time is that we don't want to ask this question right from the start, right? But we want to ask it at the end. Right? Now here's something for us to come and think about. Right? Why is this question, right, what should I buy? Right? Why is it actually not such a great question to start with? Okay, so some of you might say that, okay, it's because the range of consideration is too narrow, right? We should look at things with a wider scope of consideration, right, which is correct. Some of you might say that it's too simplistic, right? We should consider actually what the strategy is, right? What is it trying to do? How does it work? Which is also not wrong as well, right? But today we are here to talk about consistency, right? And I want to invite everyone to also consider this. Is your investment decision-making process consistent? Okay. So if it's a no, then naturally we are going to get inconsistent results. Okay. But if it's a yes, are we going to get consistently good results? Well, that's possible, right? It is possible for us to have consistently good results, right? If our decision-making process is consistent. But what else is possible? At the same time, right, this is just as likely, but consistently not as good. Okay. And then we have a third possibility. Okay. So what's this third possibility? It can be consistently based on luck. Okay. So the general approach that my team of advisors, what we observe is that most clients, when they come to us, their approach to getting consistent results is to avoid this over here, right? Trying to avoid having consistently poor results, right? And how do most people approach this? Right? Well, they tend to focus on this aspect over here, right? Clarifying your approach. Right? So here is where we often talk about why this strategy, why this allocation, right? How do we be clear that this strategy works, right? We spent a whole session going through together last week as part of this Quant Investing Festival, and we were talking about how we can go through things with clarity, right? And naturally so, because with a flawed strategy, that is definitely going to bring us more consistently poor results, right? I'm sure we can all understand that. But more often than not, investors leave out trying to address the last possibility over here, right? And we let our portfolio, maybe not 100% consistently, but generally be based more on luck than it needs to be. Okay, that is not what we want, right? Yes, luck is always flowing around, right? Sometimes we have it, sometimes it's here with us, right? Sometimes it is not. But what we want is to let our investments be more based, not on luck, right, but on what we do and our decision making, right? So how do we address this, right? What causes luck to be unnecessarily a greater factor than it needs to be, right, when it comes to affecting our portfolios? Right? So I believe a good proportion of you guys have probably seen this before, right? And for those who have invested for at least 3 years or more, you have been through the start of the US-China trade war, right, in 2018, the Hong Kong protests in 2019, where you saw the China market going a little bit down, right? And then last year we had the COVID downturn. Right? So I'm sure you would know by now, if you have invested for at least 3 years, that this cycle of emotions, it is not easy to handle at all. Right? In fact, it is so much more difficult than it seems to be on paper. Right? So for those who are new to this, they are the natural emotions that investors go through when markets move up and down, right? And it often leads to that buy high, sell low phenomenon, which naturally over time translates to losses. Right? Now, what I want to share with everyone here is not to simply just tell you to do the opposite. Right? Well, Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy. Right? Yes, we understand that, right? But in the practical sense, it is not so simple to do. Right? And we want to ask ourselves, why is the case? Right? And there are many psychology articles and books that you can read on this, right? But what we want to focus on and notice is here, right? That oftentimes when we are trying to make our investment results more consistent, right, other than trying to clarify our approach, we are often neglecting some other areas needed for an investor to have consistent success. Right? Investing is way more than just your strategy. If any one of you SUSS students, you are from psychology, right, and you've been hoping to somehow jump into finance, right? Well, this might be a little bit of good news for you, because even investment banks and fund managers, right, these fund managers, they are also looking for a role related to what you're studying. Okay, so for quite a number of years, you can see that this actually reported in 2012. Right? It has been going on for quite a while. Right? Even the investment banks and the fund managers, they know and they acknowledge that they need to address that psychology portion when it comes to investing. Okay? So how do we go about this? Right? Let's start with what we have in this circle over here. Right? The first section on developing good habits. Right? Why is this important? Because many of us, we don't mindfully and consciously select what habits we are developing when it comes to our investments. The process, it looks something like this. Right? If it's the first time you're investing, you are going to start somewhere. Right? You will make your first decisions, right? And then you have your first outcomes. From there, you interpret the outcomes, right? We have our outcomes, we interpret them, and we form our belief systems about investing, which over time, these belief systems, they are going to reinforce themselves, and they are going to affect our future decision making. Okay, the whole process, it repeats itself over and over again. So we can actually see how our habits form over time. Right? It's over here, right? But what determines which habits are formed? Right? It is not the belief systems, right? It is not the outcomes, right? But rather it is your interpretation of the outcome. Right? Your interpretation of what happens to your investments and your wealth, it matters, and it matters greatly. Say, for example, you invested for the first year and you achieve 40% return. Okay, so how would you interpret this outcome? Right? Some of us, maybe we rode through COVID last year, right? We somehow managed to buy into technology, right? Which did really well last year. Right? We had really good results. And maybe we're thinking, wow, okay, I rode through a market crisis, right? It went down in price and then it went up again, right? So maybe I can just do this for many years to come. Some of us think that, hey, it's just 1 year, right? It's just a 1 year track record. Will we get the same quality of results in the next 3 years? right? And then some of us, we think that, okay, this is great, right? So we had some results, right? What made it work? Right? Were we just lucky? Right? Was COVID actually a special kind of market crisis? Right? Was it different compared to, say, the 2008 financial crisis, the dot-com bubble, right, and many other financial crises before last year? Right? And then some of us, we might have the what we call the FOMO effect, right? So we see our friends having even better results, right? Some have doubled, tripled the money, even 10 times I've heard, right? And then we look at them and then we feel this very natural and very understandable fear of missing out, right? And we think that, hey, maybe 40% isn't good at all. Well, whichever was your way of interpretation, right? Whichever way we choose to see things, it actually reflects our values on financial management. Right? So for example, prudence is a value. Okay? Being careful is a value. Right? Being decisive, being responsive, wanting to stick to the plan, these are all values. Right? And I'm sure all of us have certain good values that we will want to apply to managing our finances. But sometimes it's not as straightforward. Right? The problem comes also when we have conflicting values. Right? So maybe we value both decisiveness and prudence. Right? One of them tells us to do A, and then the other tells us not to do A. Okay? So this is something that is pretty common. Right? And what happens over time is that we actually never somehow make our decisions in a consistent manner, right? And don't form the much needed healthy habits which should help us easily navigate market ups and downs even after many years of investing. If you know about the story of Warren Buffett, right? For those of us who know, right? Warren Buffett, he had developed such strong values and habits in his investing, right, as a young person. Majorly due to the influence from one of his earliest mentors, Benjamin Graham, right, who has been also called the father of value investing. Right? And then if we take the other end of the spectrum, right, if we look at Ray Dalio, right, then we'll see how he, as a man, he has formed very strong and very healthy habits. Not the same as Warren Buffett. Is not on value investing, but he's on quantitative investing. Right. So this is something all investors ought to think about. Right. If you are investing and you have been doing so for quite a while, are you developing some healthy investment habits? Right. And sometimes if we dig a little bit deeper, we may realize that, okay, it's normal. We may have some conflicting values stopping us. Right? And in that scenario, actually what we simply need to do is to pick one that helps us form a better habit for investing. Okay, so that's for this part on developing good habits. Right? This is very, very important. Okay, so from here, let's cover the next two, right, on recognizing hype, bubbles, and acknowledging and understanding what the media is about. Right, so we have a lot of students with us here today, right? How many of you have seen or heard in one way or another these investment headlines? There's Bitcoin, there's Tesla, there's GameStop, right? And today we are not going to cover whether Bitcoin is good to buy, whether all these individual allocations that are good to have in your portfolio. Right? We are not going to the details for that. But what I do hope for everyone to consider is, what do you think is the agenda of these articles, right? So if we do think about it a little bit more, right? Generally for news platforms, they tend to want a little bit more clicks, right? A little more views, right? Depending on which news platform it is, they may want more advertisement revenue. And how do they do this? They have some catchy words and phrases, right, which are still to help keep things factual, right, but also they are meant to drive our emotions, right? And I'm sure I don't have to tell all of us today how to take the media news with a pinch of salt, right? And this is simply just a reminder to all of us that the media's role is to report facts, right? At the same time, also to have revenue for themselves, just like any other respectable business, right? And at times, right, we may or may not get the full picture of things from what is reported, right? Even if we read multiple media sources, right, we may still not get the full picture because there are certainly things that go unreported. So just a reminder here to take things with a pinch of salt. But what we want to focus on is this. Okay. Emotional hype, which is by itself often driven and enlarged by our emotions when we read the media. Right? To be clear, here we are not talking about the usual market corrections like COVID's market downturn, which by and large, yes, they are significant downturns, but they were not so much caused by emotional frenzy. Right? Last year's market downturn was caused by a very real global pandemic. Right? The US, it could recover well from the 2008 financial crisis for a number of reasons. Right? And one of the reasons is that it was a little bit more of a structural issue leading to the collapse of Lehman Brothers through the mini bonds and consequently leading to a subprime crisis. Right? It was a little bit more of this and not that much of an emotional frenzy. And I'm not saying here that market downturns, right, which are not mainly built based upon frenzies, right? I'm not saying that these market downturns are always recoverable. Okay, please don't get that idea, right? We will not be able to know for sure, right, whether each and every market downturn is recoverable. But what we do need to note is that the downturns which are driven by frenzies, right, by emotions more, they tend to be greater in magnitude and naturally harder to recover from. Now, why are they a little bit bigger, right, greater in magnitude? The very key reason, right, a very common reason is that people tend to borrow heavily to invest when they're excited, right? And this is called using margin or using leverage investments, right? And what it does is it pushes your price much higher before it eventually comes back down. Right? So a key thing for us to think about here is what causes people to buy more emotionally rather than logically. And no, it's not because some of us might be a little bit more gifted than others, right? There are a lot of intelligent people who do get caught in these bubbles. The problem usually is the lack of fundamental clarity, right? Bubbles created by these kind of situations, they are much, much harder to recover from. Okay, so let's take a look at this example. Here we have the NASDAQ composite. Right? For those of you who are not familiar, only the largest US companies can have a chance to be part of the NASDAQ. Right? The requirements for a company to be included in the NASDAQ, they are much higher, at least compared to, say, the New York Stock Exchange. Right? And so the NASDAQ today, it comprises heavily of our big tech firms, right? The US big tech firms, Apple, Google, Facebook, etc. Now, here's what happened. Right? In 1983, the internet was created. Right? But in the 1990s, not everyone understood what the internet really was. Right? People knew that the internet was going to be for the future, but it wasn't clear to everyone how the internet functions and how it would change our lives. Right? If you just do a quick search, maybe on YouTube, you are able to find a lot of these kind of videos. Right? For those of you who are in your 50s and above, right, you would have lived through this time. Right? If you were a young adult, right? Back then, you would be in your early 50s right now, okay? So you'll probably be able to recall how it was not until companies like our Microsoft, Facebook, Apple becoming more prominent that people really started to understand what the internet is. But yet in the 1990s, the NASDAQ climbed 3 times, 4 times, right? And it led to the eventual bursting of the 2000 dot-com bubble. This actually took a whopping 15 years to recover. Okay. And also for China, right, this is the Shanghai Stock Exchange Composite Index, right, SSE Composite. So those of us who are a little bit older, do you remember a time when everyone said China was the way to go, right? Because it's having double-digit GDP growth annually, right? 10%, 11% GDP growth. Right? Yes, at that time we knew that China would grow. Right? It was definitely growing well, right? But also at that time, China was much more closed up as a nation and economy than it is today. Right? No one could say for sure that China would be closing in on and overtaking the US GDP the way it is today, right? Now, the truth when we look at all these things, right, is that actually a lot of these things, they are just hindsight, right? You always say, what's the point of looking back at all these things, right? If they are all just hindsight. The thing is, we want to really come in and learn from history, right? At those points in time, prior to these giant bubbles, right, it was not easy to tell at all whether prices are majorly driven by emotions or were they actually driven by fundamentals, right? Real earnings, real happenings. So how do we deal with this? Right? We need to ask ourselves this, right? Is it worth the risk? And I ask this question because for many new and young investors, the most common portfolios we tend to see when investors come in is somewhere around the percentage of 80 to 90% allocation into things that actually a lot of people are talking about, right? And everyone else is probably also buying. And there's no big danger from this, but we want to consider this, right? If we are always buying what everyone else is also buying and talking about, not to say that it is going to be definitely bad for us or catastrophic, but isn't it natural for us to eventually fall into these bubbles, right, which are driven by emotional hype? Right? It might just be a natural outcome, right? It might just be a matter of time. Right? So that's one. Right? And then the second thing is, we're not saying don't buy what your friend buys. Okay, our friends, our family, they care for us, right? They want us to also be able to have the good things that they have in their lives, right? Which is very, very kind, very nice, very great, right? To have all these friends and family in our lives. Right? The issue is we are more often than not too overly concentrated in these positions. Right? If there's a chance for an 80% decline in price, for example, then is it worth concentrating your position? And here we go back to the old saying, okay? So what we want to do is avoid the FOMO effect. Right? Please diversify your investments. Right? The risk of emotional frenzies, they are rarely worth it. Right? Yes, maybe without buying, others may be temporarily earning while you are seeing how your money is, maybe they're still in the bank. Nevertheless, right, the risk of such a sharp decline, right, it is rarely worth taking, right, especially if you're a new investor. So remember that your first outcomes, they are going to contribute and help you form your first beliefs on investing. Right? Do you truly want to risk your first investing experience on such concentrated positions? Okay. So if you sense a little bit of overexcitement of things, be on guard. The solution is not so much to decide to buy or not to buy, but rather the solution is to limit your exposure and diversify. Okay. And then lastly, I just want to come in and touch on belief systems. Because over here, let's ask ourselves this question. Okay. What do you believe about investing? I mentioned this because through the many people that my team and I have spoken to, there is a portion of investors that as advisors, we tend to get a little bit more worried about. And that's people with some disempowering beliefs about investing, right? Some not so helpful beliefs about investing. So we have actually met investors, right? People, individuals, right, who see the markets as gambling, right? And then we have also met some who think that, hey, it is normal to have some losses in our investment, right? Since the markets always go up and down, it is normal for us to be losing money at times, right, in our investments. And then from here, guess what happens, right? When our belief systems, they don't help us, we tend to get off to poor starts, right? And we have poor outcomes, and then the cycle, it repeats itself. Right? I'm sure from time to time, some of us, we are going to come across with a friend or two who says that, hey, almost every investment that I made, actually, I lost money. And sometimes the problem is not so much the investment, but rather what we believe in. And then conversely, on the other hand, we have also seen investors who have very empowering beliefs about investing, right? And sometimes you're going to hear a story or two on how every investment that this person makes, he makes good money. Right? Sometimes we say that, hey, this person over here, right, this guy, everything he touches turns to gold. Why? How is it possible that this guy, right, is doing so well for his investments? Right? And then on the other hand, there are those who are having a lot of trouble. Right? There are many possible reasons, right? But a lot of times it comes back to the very root of what we believe in. Right? Sometimes we can find what we call a self-fulfilling prophecy. Okay, so I hope that every one of us here will give this some thought. Right? What do you believe about investing? In my own experience, I've seen many people, right, fathers, mothers, sons, daughters, right? You guys, you are the most caring, right, the kindest, the most down-to-earth people I've ever met. And to me, it is really such a pity that it's so unfortunate. Somehow you are not still getting the investment results that you deserve. So if you're out there, right, my heart goes out to you. For the SUSS students, right, if you are doing the investment advisory case challenge, right, do remember that as you do up your proposal, we are not here to just give a portfolio and then we just tell clients, hey, this is what you should buy, just invest this, right? No, that's not our job. Right? We are here to guide people just like you and me, right? People with a family, a career, relationships, hopes, dreams. We are here to bring them on a guided journey of growth as an investor. Okay, and so with that, right, I actually see that I'm ending a little bit early today. Right? I've come to the end of the sharing. Right? I do hope that everyone here today, you could get a better picture of how investing, it is much more than the approach or strategy. And it is through the development of these other areas that make us able to achieve that consistency over time. Okay, if you guys have any questions, right, please feel free to just type them into the Q&A section on Zoom. Right? And at the end of this session, I'll be able to answer them for you. For now, right, let's go on to the quiz, right? For the Quantitative Investing Festival, every session, we are going to have a short quiz of 2 questions, right, MCQ, right? And for every correct answer, we actually stand to take part in that lucky draw and have a chance to win the prizes. Okay, so give me a little while I bring up the quiz for everyone here. Okay. So please come in and join the quiz. Right. You can simply scan this QR code, right, or alternatively, you can use on your phones, right, to go to ahaslides.com /PGU43. Okay. Don't worry, the questions are very simple. Okay. Let's give it maybe another 10 seconds or so before I move on, and the QR code won't be there big. But for those of us who are still trying to join, you can go to your browser on your phone and then type in ahaslides.com /PGU43. The link will be up there at the top of the screen. Okay, I'm going to remove the QR code now. Okay. So as promised, there are 2 MCQ questions. And for each question, you have 60 seconds to answer. Okay. Okay, we're going to start soon. First, please provide the last 4 characters of your NRIC and passport number, right, and as well as your name and email address. This is to help us recognize you if you are the winner of our lucky draw. For lucky draw, we are giving out CapitaLand vouchers, right, and as well as all points mega packages, and I believe 3 possible packages, which are going to help us, right, those of us who are very keen on quantitative investing, right, and those of us who are keen on trading volatility. Right, how do you know when to enter and when to exit? Right, the answer is actually found in all points mega cross package. And if you are the first big winner of our lucky draw, we are going to wish you a big congratulations. Okay, so please press join, right? Please go to your phone and press join. Don't forget to press join. Okay, I'm going to start. Okay, let's go. All right, the first question. What is something that every investor should work on in order to bring greater consistency in our results over time? Okay, we have talked about a number of things today. And it is certainly possible for us to always try to time the market, right, to conduct research, to try to practice good habits, and to react faster to market conditions. Right? But what is the thing that we want to really focus on so that we have that consistency over time? Okay, 15 seconds left. Are we going to see all correct answers today? I hope so. 3 seconds. Okay. Okay. Yes, the answer is cultivating and practicing good habits. Right? I wouldn't say that conducting research, right, is something that is going to give you that consistency over time. Right? The reason is because research is always endless. Right? And if we are always focusing on trying to read a lot and learn a lot, right, how are we going to make sure over time that we are considering almost everything that's going on in the market? Right? So this is really something practical for us to think about. Okay, so let's move on to the next question. The second question, diversification is key to every new investor because so I talked about this just now. Is diversification important because it's easy to do, right? Or is it important because, you know, maybe the lack of experience, it causes us to not be so suitable to pick stocks? Or should we always just go for low risk investments because we are new? Right? Or is it something to do with our belief systems? Okay, so the last 5 seconds, right? Let's see. Okay, yes. Right. So the answer is diversification is key because the initial outcomes, they are going to majorly contribute to our investment experience and our belief systems over time. Okay. So that's all for this quiz today. Thank you for participating. And if you are the winner of our lucky draw, we will be announcing you as the winner on the last day of our festival, which is on the 2nd of October. Okay, so for now, let's move on to the Q&A section. Right? If any one of you have a question that you want to bring up, right? It can be about the markets, it can be about investing in general. Please feel free to just type them in the Q&A function in Zoom below. Okay. Okay, I'm going to see I'm seeing a number of questions coming in. Right? Not a lot, but we still have a number. Okay. Okay, so the first question is this, right? If I diversify to have a smaller allocation to some, I'm saying Bitcoin and electric vehicles, okay? So how do I prevent my portfolio from taking a hit if it eventually proves to be a bubble? Okay. Okay, so number one, I do understand that currently things like electric vehicles, right, things like our cryptocurrency, they are generating a lot of excitement, they're generating a lot of hype. And we actually don't know for sure whether these are going to turn out to be very big bubbles, or are they actually going to just very naturally become the next big thing in the world, right? We don't know, right? But to answer a question on how do you prevent your portfolio from taking a hit, right? The truth is we are not going to be able to 100% prevent that possibility. Right? But what we do achieve when we diversify our portfolio is, number one, you are going to open up your portfolio to this very important thing called rebalancing. Okay. So for those of us who are not familiar with what rebalancing is just simply, maybe you say that you allocate 10%, right, into EVs for a portfolio. Right? And then EVs will climb very well, like maybe they went up 20%. Right? So now your EV allocation is actually at 12% instead of your original 10%. Okay. So what you do here is that you rebalance your portfolio, sell off a little bit of the EVs so that your EV allocation, it goes back to 10%. Right? And what happens here with this practice of rebalancing is that over time, right, even when you see your allocations into more risky products, right, more risky investments, they have gone up in price, what happens is that you are actually taking the profits off the table. And yes, maybe over time, right, you may find that this allocation that you're invested into, it climbs very, very well, right? And maybe you look back and tell yourself that, hey, it would have been better for me to not have taken off the profits. But we still want to go back to the initial and very important concept of managing risk, right? The higher the prices climb, the greater the risk. And at the same time, when the prices have already climbed, I'm sure there are also other investment opportunities out there for you to take advantage of. Right? We always have the option to change up our investment allocations. Right? And rebalancing is one way to do it. In fact, it's a way that many fund managers, professionals around the world, they are using this and they're doing it very consistent. What we are not seeing enough of is retail investors doing rebalancing for themselves. Right? So how do you protect your portfolio? Right? We can't prevent it 100%, but we can do rebalancing, right, when you are diversifying your portfolio. And then the second thing that I do want to come and mention over here is that when it comes to diversification, for those of us who were here when Ingwan was speaking from All Points, right? So he mentioned that there is a third way to diversify beyond just adding other securities, beyond just adding different asset classes, right? Maybe you have equities and then you have bonds, and then you add gold, and then you add real estate, and then you add agriculture, all these asset classes, right? This is still a second layer of diversification. There is a third layer, which consists of a diversification of strategies, right? Why do you say this? Because when you are diversifying, a lot of times you are going to still face a situation when there's a market crisis. Doesn't matter what you bought, everything is going to go down, right? So a diversification of strategies is going to help you there, especially if you have a little bit of negative correlation among your strategies. Right? And one of the strategies includes volatility. And for those of us who are already using altcoin strategy, you would have recently, over the last week, we did have a little bit of exposure into volatility ETFs, right? Given the recent China Evergrande news. Right? But yes, right. So this is exactly how we are diversifying among strategies. Strategies may be one of them. When it goes up, the other is going down, right? So for those of you that are keen, right, you can go and explore a little bit more on all funds strategies. Right? And just let me also just put up over here. Okay. So yes, if you are keen on all strategies, right, you can always look for them through their QR code. Right? And yes, there's always a more different way to diversify our investments. Okay, I see a question coming from Adrian. How do I calculate my portfolio return if I handpick my financial instruments? Is this portfolio return something that you are doing for quantitative analysis? Or is this something that you are looking for to just very simply look back on how you've done so far, right? Because if you are just trying to look at how you've done, it's actually very simple. You just take the difference in your prices, right? But if you are looking at quantitative analysis, right, then it really depends on what you're trying to do in your model, right? You can try to take returns based on 6 months, 1 year, right, 3-year average return. There are many ways to do it, and it really depends on what you want to do. Okay. Okay, I have a question on how will the Fed tapering affect the markets. Okay, so I'm not going to give a very specific answer over here, but for the benefit of everyone who's learning about how to invest, right, we need to come in and think about what is the Fed's role. Right? So sometimes when we think about the Fed tapering, or we think about maybe this year the Chinese government has been doing a lot of intervention, right? A lot of new policies have come out, and then it has affected the China market this year. Right? We want to ask ourselves this question: when the government is involved, what are they trying to do? Right? What are they trying to achieve? Okay, so let's consider this, right? Is the Fed trying to help the economy, or are they trying to actually maybe make things difficult? And then you slowly find an answer from there. Okay, I'm not going to give a very specific answer, right? But we should always start off with understanding the intentions behind the different roles that are being played in the market. Okay. Okay, I have a third question, right? Is leverage something everyone should consider? Okay. Okay, maybe this is because of this over here, right? Okay, so I have this slide over here to show how an investor actually grows over time, right? And how, as advisors, right, for those in the investment advisory phase challenge, you are to bring your client along a journey of growth. Okay, so maybe you saw that you have leverage over here, and maybe it should be part of every investor's journey. Okay, so I wouldn't say that it is something everyone should have. Okay, it is something that everyone can consider, but it's definitely not something everybody should have. Okay, so first let's talk about actually what happens when you don't understand or you're not aware of the mechanics and the risk of leverage. Right? If we are not aware and we don't understand, definitely we should not be going anywhere near it. Okay, leverage and doing things on margin, a lot of times it has led to disastrous outcomes. Right? We don't want to see or hear any of our clients or friends, people around us, right, having that dangerous situation of suddenly needing to fork out a large amount of money to top up the investment accounts. It is mandatory, it is obligatory, right? And we definitely don't want to be in that situation. Okay, but that being said, right, those of us who are actually open to learning about what leverage is about and how it can be a useful tool eventually in our investments, right, we are more concerned about where individuals or clients are at, okay, in their stage of growth as an investor. Right? So if, consider this, right, if you find someone and you actually can tell that that diversification is not so much ingrained as a value into this investor. Right? If we are not appreciating diversification yet, then actually what are we doing? Leverage by itself, it is actually very useful and very helpful. We are going to get the most out of it only when we have this thing called a good risk return ratio. Okay, if you are having a very good risk return ratio, that's when you leverage your portfolio, you're going to get so much out of every unit of risk that you are having. But if, as investors, we are still not able to appreciate what diversification is about, right? How do we get a better risk return ratio? Then would that be the case that leverage would be very dangerous and very unsuitable for us? Okay, we have seen cases whereby investors or traders have 2, 3, 4 stocks, right, or maybe just 1, 2 funds in the portfolio. They are both equity and they are very much correlated with each other. And what happens when you have leverage on this kind of portfolio is that you make yourself fall into a very dangerous position. Okay, so leverage, right, it is not for everyone, right? It is more important for us to think about and consider whether we are ready to kind of explore this stage of investment growth. Okay, okay, and then maybe I'll just take one more question. When should I add a new fund or stock to my investment portfolio? Okay, I think this is a very good question and a very practical one. Right. Well, my question to you, let me ask you back a question, right, for the kind individual who came out and asked this question. Has your full diversified portfolio been completed? Okay, because there are diversified portfolios that require at least, right, to match the level of diversification, 20,000, right, 50,000, 100,000, right? Some hedge funds will tell you they need 1 million. Right? And actually it's only natural that, especially when we are young and we are starting off, right, we are not going to place too heavy a sum into our investments, right? If we are starting off straight away, right, and we would like to exercise the value of prudence, right, then it's only natural that we don't have enough to create a fully well-diversified investment portfolio. And so how do you come in and add a new fund and stock? Right? It's when you are trying to progress and move towards this new portfolio creation. Right? Maybe you tell yourself that to create your diversified portfolio, you need 5 funds, okay? And because of limited capacity, you maybe only have 2 or 3, right? And because of this limitation, maybe your first 2 funds, they are globally diversified instead of maybe you are using Asia, for example, okay? So it is about how you are going to build towards that diversified portfolio. Over time, when we work, we are going to have income, and then we are going to have more and more to invest and top up in our portfolios over time, right? And that's when you want to come in and adjust the allocation of a portfolio. If it's a little bit complicated, just think of it this way, right? Are you diversified enough? If you're not, right, then try to add something else. If you have 100% into US and you have some spare, then maybe you want to consider something else on top of your US allocation. Okay. So yes, that's all for today. Right, I still see a number of questions coming in, but rest assured, right, that if since we are not able to have all your questions answered today, right, we will still get back to you individually through emails, or we'll maybe even answer some of the questions in our subsequent webinars as well. Okay, so that's all for today, right? I do need to have the disclaimer up, right? And thank you everyone for coming and participating, and for those of you who are in the case competition, right, I wish you the best of luck, right? I may or may not be seeing you for any coaching sessions, but I do wish you all the best. And for those of us who are taking part in the Quantitative Investing Festival, right, just do note that on Saturday, we are going to come in and talk about the multi-strategy portfolio, right? One that encompasses the elements of trading volatility, the elements of the all-weather strategy, right? And how each of these strategies, they are going to increase your risk return Sharpe ratio even more to really benefit and match or even outperform the rest of the general market. Okay, so if you are you have only signed up for today's session, please make sure to go and sign up for Saturday's session as well. And I look forward to seeing you in that session. Okay, so thank you everyone for coming, and I look forward to seeing all of you again. That's all for today. Bye-bye.